All right, good morning, everyone. Welcome to the trade findings and adjustments for Hurley Investments on Thursday, the 21st of 2022. The reason why we are having this particular, I don't know, I guess this particular lesson is what I'm going to call it, is I get the question over and over and over again, and it keeps coming back to me on Kevin. What is the problem with bonds? Why are bonds such an issue right now? So let me just make sure we have this correct. So the question I'm answering is, Kevin, come on. Kevin, what is the problem with bonds? And I'm just going to start throwing some stuff out. Let's make sure you guys understand. If you have a 60-40, which is a moderate growth portfolio, when do you beat the market? And that's a question for you guys. I want you guys to think. I'm going to try to stimulate some thought processes in your head. Talk to James. He will tell you. I love it. And that, James, you're getting picked on. A couple people said they're frustrated that I said you're my favorite today. Someone says, just ask James or let him do the webinar for you. I love it. Okay, moderate growth portfolio, 60-40. I'm going to even do this differently. Let me change the question altogether. What does that mean? What does a 60-40 moderate growth portfolio mean? Will someone tell me? We're going to go through bonds today. This is our bond education. For everyone here, welcome Brady Simmons. Brady Simmons is joining us for the first time. He will soon become a third registered investment advisor for Hurley Investments. And we still are, for those that know Jeffrey Dunyan, we still are waiting for Jeffrey to get on board. He's working through some things because he also teaches an education. So welcome. All right, James is killing it today. 60% stocks and 40% bonds. So when do you beat the market in a 60-40 bond portfolio growth? When are you supposed to beat the market? James, you are money today. It's actually Jim Kohler. So in theory, when we have a down market, because the bonds are supposed to stay at their par value, you get paid an interest, and only 60% of the portfolio is down. In real life, never. You never have the opportunity to beat the stock market in real life. And that's because bond premiums go down. If you're in the market on only 60%, it means 40% are giving you, over the last 25 to 30 years, just a piss poor zero interest rate. And you got to take out their fees, their commissions, they're turning you into new stuff, administrative fees. You never have the opportunity to beat the market in a 60-40 moderate growth portfolio. You literally have screwed yourself. Well, Kevin, you know, maybe last year you didn't beat the market. You were paying for protection you didn't need. I understand that. You never have the opportunity in this model. With Hurley Investments, over time, you're going to have the opportunity to beat the market and beat the market handsomely, like a 43 to 68% return on only a 16% up year in the market. But it's a process. Collar trading is a process. So let me go through really quickly with you bonds or bond pricing. I put the link in here. It's Investopedia. Pricing of bonds, just a couple things to understand. The face value or the par value of a bond is usually $1,000. And that's where you're purchasing a new run of bonds. For example, Apple will say, hey, we're going to sell $1 billion in bonds. And those bonds are going to have most recently, you know, I'm going to say, I'm just going to go with January of this year. January of 2022 equaled roughly the prime rate, which was 0.25, plus roughly 0.5% premium. And the interesting part is Apple's bonds roughly paid out 75 cents, right? Yearly. Their dividend pays out more than their bonds. But bonds are listed as AAA and they're the perfect investment, right? With Apple, you had to invest minimum 10K or 10 bonds worth $1,000 face value. We usually call that par value though. Par value, which you get back in 10 years. Kind of a neat thing. You get your $1,000 back in 10 years. Now, does that always happen? Do you always get your $10,000 back? So let's put that question in there. Do you always get your, I'm just going to call it par value back? And I know some of you are going back to 2008, right? Well, damn it, Hurley, I didn't get my par value back from city, state, or county bond funds. California gives IOUs. Do you always get your par value back? Why are you guys being so shy today? I want some answers even if they're wrong. Brady, you need to answer some of these because it'll help you test for your 65. There we go. Mary's like, not always. Because companies can go through bankruptcy, cash flow problems, yeah, I mean, not usually, right? But that's the premise or the theory. You give 10,000, you get 75 basis points or 0.75%. So doing my math, on $10,000, which was the minimum purchase price for Apple bonds, on $10,000, you got 0.75%. You got paid $75, a coupon of $75 every year for the 10K 10 bond investment. What do you think? Good idea? Good investment? What do you guys think? Okay, so let me go. You said not really. So, William, if you said not really, why? And what if I put underneath it safe investment? Absolutely, I like it. Absolutely, right? It's absolutely a safe investment. For crying out loud, Apple has $200 billion. But William, you said not really is a good investment. So why? Why is it not really a good investment? Why is it not really a good investment? And I know what you're going to say, I think. It is a safe investment, but it's not really good. There you go. Because it doesn't pay shit. I'm just going to say anything. I got to change your wording there. And I'm going to kind of, Jim actually says something, especially after fees, right? So here's the question. So are you willing to take more risk in the stock market? And of course, we already know the answer is yes. But again, let's go to the problem, right? Here's bonds. Here's how they work. Let's go. What is today's problem? Right? Let's hammer it out. What is today's problem? Well, the Fed interest rate is now between 1.5 and 1.7, right? So we have a problem, right? Problem is January's sale of bonds was 0.25 plus the 0.50 premium. Something to get you to buy the bonds, right? Today's sale of those same bonds would have to be priced at 1.75 plus the 50 basis point premium that Apple puts on, which equals 2.25%, which is 3 times what they sold you in January. So today's bonds pay you 3 times as much. Let me ask you a question. Can someone tell me why is Warren Buffett buying up all of January's bond sales from Apple? Why would the smartest investor in the world that thinks bonds are crap, why would he be buying up bonds that pay $75 on every $10,000 you invest? Why wouldn't he go buy $10,000 of bonds at today's price, right? If you don't know, you can put some question marks in there. But why would be, it's like, okay, Kevin, I don't get it. There's some question marks. Thank you, Jim. Thank you, William. I mean, he's spending hundreds of millions of dollars buying these things up. And we know they're just going to go, they're going to change. They're going to be higher in price July 27th, next Wednesday. Boom, you can tack on another 1%, right? So this phenomenon, I can't spell worth beans, is called bond parity. The 10K you spent in January is no longer worth 10K. Something has happened to that pricing of those bonds. Your face value, your par value has to reflect the newer interest rate hikes. And I go through that up above here where I talked about bonds. Bonds are, it's that top paragraph. Bond prices tend to be less volatile than stocks. They often respond more to interest rate changes and other market conditions. This is why investors are looking for safety and income, often prefer bonds over stocks as they get close to retirement. A bond's duration is price sensitivity to changes in interest rate hikes. If you look at the interest rate hikes, we've gone up like 7%, 700% from the December, January bond sales. 700% from that 0.25% that was our prime rate, right? So here's the easiest way to describe it to you. Those January bonds still have 9 years and a bit left in them. You take those 9 years, you times it by the current interest rate of 1.75, and that interest rate, I need to do it on my calculator, I shouldn't do it all in my head. That interest rate equals 15.75% interest paid out with the new bonds. $15.75, add in your 0.25 for this year. Those bonds, oh, I guess that total, 16% times the 10K equals $1,600 of lost bond par value. So they trade at $8,400. You take up that interest you could have gotten, the interest paid for the year, you subtract that out of the value of those bonds. The $10,000 staunch you paid December of last year to receive the Apple January bonds that pay out 0.75%, that $10,000 is only worth $8,400 in your portfolio today. That is how they make them. That's how they find parity. That's how they even out the bonds. That's how someone will churn you out of a bond fund for a $1,600 loss, but tell you, hey, we're going to get you into more bonds. Better bonds are going to pay you a higher interest rate. It's a losing proposition. Not only that, most firms or advisors get paid somewhere between 5 to 7% commission to put you into a bond fund. So on that 10,000, you probably paid 10,500. 10,000 for the bonds, 500 to purchase those bonds for you, which cost me like $5. I pocket $495. And year to date, those Apple bonds that you spent 10,000 on are really worth 8,400. Here's the game. Every 2 years, interest rates kind of have been going, well, they're starting to go up. They've been going down, so you're kind of holding on to those bond funds that you've had before, because I can't justify, hey, I need to turn you out of these bonds into lower paying bonds. Although remember, this works the opposite way. Hey, what we spent 10,000 for is now worth 11,000. Let's book a profit there. I'll put you into some new bonds. The stories to get people into bonds is just utter bullshit. But your $10,000 worth of bonds only have a par value or a tradable value today of $8,400. So this is where your advisor comes in and says, hey, Apple's doing some July bonds. They're going to pay, 2.25%. It'll pay you 3 times as much as your current bonds are getting you into. Can I go ahead and, I'm going to shift you out. I'm going to book a loss in your portfolio. We're going to take some tax advantaged losses to put you into something new for a profit. I get paid $500 in January, put you in. I get paid another $500 for putting into it in July. You've lost $1,000 paying me commissions. You've lost $1,600 on the position. It's about a $2,600 hit overall, or a 26% loss in your account. I'm paid. You're now in better bonds. But the key, or the question was, why is Buffett buying up these old ones? Buffett's buying them up for $8,400. He can wait 9 years to get paid $10K again. So Buffett's going to make 9 years at 1%, right? Which is $750 minus the first year. See, that's already paid out. So he's going to make, $675. Plus he bought him at a discount of $1,600. I'm doing $22.75. He's buying up these old bonds because he's going to make a 22.75% return over a 10-year period of time. and he can sit on it. He's got billions of dollars. His bond portfolio outperforms the market so often at Berkshire Hathaway because he's purchased these discounted bonds. As interest rates started to go higher, he's buying the old ones at this discount, getting into these new ones. I mean, for someone that has what, $168 billion, to put $1 billion that's going to make a 22.75% return over 10 years, he's playing the other side of the game. He's playing the insurance side of the game where he's racking up the money, taking advantage of dumb money, or taking advantage of investment firms that need to clear bonds off their books to get paid a new commission, and so it doesn't look as bad. This is the problem with bonds. This is where the run of bonds that we've had for 30 years where interest rates were falling and your previous bonds were paying more than the current bonds. This is why people have not liked bonds. The last 30 years, you had to sell higher paying bonds to get into lower paying bonds, but you had a little bit of a premium. They weren't being sold at a discount like this example. They're being sold at a premium. And not much. I mean, 0.25% rate hikes for the year. Yeah, you're making $250 more than when you bought them at, right? This is the game advisors play with bonds. And really, if you're being put into a bond, it's because they're doing what everyone else does. You will never beat the market. It doesn't offer you that opportunity because 40% are in bonds and because bonds go through parity or equilibrium where they average out their pricing. Plus you got to pay advisor fees and commission fees and fund fees. This is why we don't do a 60-40 or ever go into bonds at Hurley Investments. I'm not saying there's not a point where, hey, if you had $25 million and you wanted $5 million to be tax-free muni bonds, yeah, we would sell them to you, but we would have a disclosure that helps you understand. You kind of got to stay in them the whole time. The interest rates could go higher so you could get better tax-free payments down the road. Your par value can and will most likely go down in the next 20 to 25 years as interest rates go up. But it could create some tax-free income for you. That is one of the advantages of bonds is if you do the treasuries, the city, the county, the state, they're usually tax-free, you know, coupon payments. Ooh, I got $750 tax-free a year. Wow. Probably won't fix your taxes or adjust it one way or the other, right? Any questions on bonds? Are you guys now able to better understand where bonds are not in your best interest? Gonna give you guys a second. So William, interesting comment. So Kevin, how liquid are the bonds? In all honesty, there are market makers, there are insurance companies, that there are banks that are just trying to have another asset to loan against. The bond market is very liquid. I'm going to say as liquid as the stock market almost. So it's very liquid. They trade all the time. I'm only familiar with more what the banks and what Buffett does is they buy or had in the past have been trying to buy the older bonds and get paid a fixed amount because they can loan against them. Obviously, it hasn't been exactly in their best interest, which is why after 2008, they were forced to get U.S. Treasuries, because it doesn't make sense to buy these bonds when it was going down a quarter point each year and, buying them for 10,250 and taking a quarter point hit on them. But again, they needed an asset that was considered a risk-free so they could loan against it. So hopefully that answers your question there, William. Any other questions about bonds? You guys are going easy on me. William, you're killing me. Kevin, what do you get paid on bonds? Well, because I'm not going through a broker dealer and we are the Hurley Investments firm, I get like 7% on a bond. I get 5 to 7% on an annuity. It pays me very well. I just don't do it because it's not in your guys' best interest. There have been the time where some older people have wanted stuff in an annuity. I explain just like this, the pros and cons and how the annuity in the last, probably since 2003, really hasn't made anyone money unless they stayed in it for that 7 to 10 year period of time. And if you're older, I know there's a safety factor with having your stuff in an annuity, but if you need that money for an accident, broken hips, medical bills, literally you need to stay in it 7 years or you're going to come out with a lot less money than you put in. It's just, they're not a good investment. They're too damn expensive. It's an insurance product. An annuity is an insurance product, so it just is not in your best interest. And I get paid, I could be putting people in this all the time, but it's not fair. It's not right. It's not where they need to be. People, I think, misunderstand bonds and annuities more than anything else, other than mutual funds, right? All right. Any other questions? So, Mary, yes, the Apple December 2021, which actually are titled January 2022, the sale of all of the Apple bonds in December that are listed January 22, 32 bonds, those 10-year bonds, they all went with about 0.75% of interest. It was the prime rate of 0.25% plus premium that they paid. So yes, the $10,000 in bonds that were purchased last December, that went into effect in January, that have a 10-year run rate, Apple's bonds are worth $8,400 today. They're actually less than that. It's probably fees. I haven't figured out exactly where they're at. They're sitting around 8,200 and change. But yes, Apple AAA rated bonds that you spent $10,000 for, cost you $500 to get into and a commission fee. In essence, you've lost, they're really trading at almost 83. 83 minus, the 16 plus a 520. Yeah, I mean, you've lost 21% on your Apple bonds this year. And you're being told it's a paper loss. So if you hold on to them for the 10 years, you're going to make $750 every year for the next 10 years, and then you'll get back your 10,000. If you have an emergency, you need the money now, boom, you'll get back, on your 10,500 you spent, you'll get back 8,400. They'll take a 21% loss. Think about it. Otherwise, every bond that was sold previously would have no value. Everyone would just be stuck in it, but there's a market for them. How to make that market work? If interest rates are going down, the previous bonds are worth a little more. If interest rates are going higher, those previous bonds are worth less. That's that inverse relationship. Interest rates going up, bond premiums are going up, but bond values are going down. The reverse, interest rates are going lower, bond premium or payments are going lower, but bond values are going higher. And that's how they even everything out so that it's pretty even across the board. All right, guys. Hey, hopefully this was helpful for you. Hopefully this is understanding bonds. It's funny. James just typed in, maybe you could do something similar to this on REITs. And William said, could you maybe do something similar like this on annuities? So yes, I can do both of those. Yeah, maybe that'll be our next trade findings and adjustment for the next couple of weeks. We'll work on understanding REITs. We'll work on understanding annuities. And that's something, again, the more education I can get into your guys' hands, I think the better educated you will to be able to make your best educated decision, right? All right. Hey, guys, I appreciate your time. Have a wonderful rest of the day. Let's take a quick check on our markets. Market opened up flat, went down 0.8% at one point in time. We're now up 0.64. Again, I will get Mondays posted. With me being in the hospital, I forgot or missed that Dave Westlake was not posting. So I will do my own posting and editing on these files for you. I will get Mondays up this afternoon. I will get this up this afternoon and have them available for you guys to go through. Yes, William, we are letting some things run right now. Kind of scary this morning, right? Apple we're letting run. Boeing we're letting run. Baidu has puts that are way out of the money. Disney we're letting run. Ford has protection way out of the money that are kind of worthless. Google we're letting run. JP Morgan, the banks we still have protection on, but they're out of the money for the most part. Lockheed Martin has protection on. Micron has protection way out of the money. It's way at a lower price for their earnings. They've run really nicely though. Going through Square we're letting run. Under Armour has protection on and it's still going down. Visa, we moved our protection up to the 215 mark. So we're really looking to roll protection up. Visa, Verizon has protection on as well. So we're trying to be nimble, but we've let some things run with old protection. We may keep that old protection on. That won't make up a whole lot on the way down, but we may just keep it on to get through these earnings with paying as little as possible for protection as we see the market rising in general. So good question. Ask me that one again on Monday for our commentary. All right, I don't see any other questions coming in. Guys, I really do hope this was helpful. I really hope you look back on these notes and see how and why bond pricing is working and how, yes, you can take, by the end of this year, if we raise another 1.5 basis points, you literally could take a 40% loss on bonds that were purchased, well, 45% loss on bonds that were purchased back in December of last year that went into effect January of 2022. Nothing like losing 40% on what's considered a safe investment, right? All right, guys. I will look forward to talking to you on Monday. Have a good day. Bye-bye.